If you're 55 and the market drops by 25%, do you have time to recover? The answer isn't always about your risk tolerance anymore. It's about your timeline. On today's episode of The Capitalist Investor, we will dive into your risk tolerance and how to prevent mistakes in the future. All right. Hello, everyone. Thanks for listening this week. As always, you have me, Diamond Hands D, and this week, making his debut, as it were, Jack Root. How's it going, buddy?
Good. How are you doing?
Hanging in there. So, hey, Jack, this is your first time on the podcast here. So, obviously, you're working here at SWP. So, yeah, why don't you just tell everyone just a little bit about your background and kind of what you've been working on here at Strategic Wealth.
Yeah, so like Derek said, my name is Jack Root. I'm an associate advisor here at Strategic Wealth Partners. Mostly right now learning the investment side and doing some of the operations work in the background, help out Derek and his clients with a lot of stuff. And so, yeah, I've been here for, I think, 9 months now. And so
almost
it's flown by, almost a year. It's flown by, but it's been a great experience. And, yeah, I've loved it.
All right. Well, we'll take that. Is he telling the whole truth? We'll never know. No, he's been doing a great job here, as well as Sam, who some of you guys might have talked to as well. So really helping out in the operations department and learning the back end of the business too. So that's good. So yeah, this week Tony's on assignment. Dave Abate had a little technical issue, scheduled himself a few too many meetings, it looks like. So Jack's going to help us out. And this week we're talking about, kind of risk tolerance. I saw this topic and I thought it was very apropos for kind of the environment that we're seeing right now. So I thought it'd be a good idea to kind of talk about your risk tolerance and how you can kind of think about protecting your assets in turbulent times. So yeah, let's get into it, Jack.
Yeah. So I guess the first question that I think we want answered is, when you're looking at investment risk, what is a greater risk for retirees? Is it returns or the time?
Yeah. So that's a really good question. So, I would say as retirement approaches, volatility becomes much more of an issue for you. So, obviously, you're in your 40s, your 50s, you're saving, you're working. A lot of times you're raising a family, driving kids around. You're not really thinking about the kind of the ins and the outs of the stock market. I would say we really want to have a plan, like we always talk about here, kind of set up your risk tolerance, but you're really not getting in there, moving things around a whole lot. But as you approach retirement, as you get into retirement, the game changes very much. And I would say that's probably one of the things when I'm talking with people that they seem to understand the least, really, is that, is not just about, your rate of return anymore. I think that's really where people's mindsets need to change a little bit. It's like, hey, if the market did 10% this year and I did 11%, then I'm winning, right? Mm-hmm. So it's not always about that as you're getting closer to retirement, because those drawdowns are going to hurt you more, is essentially what it comes down to. So the sequencing of returns also becomes an issue. So what does that mean? So, Jack doesn't, well, he might remember this, but from afar, but 2000 to 2010, that time period in there, they call that the decade of no returns. So obviously 2008 is in there, and there was a giant drawdown. But, essentially between 2000 and 2010, the market was flat over that time period. So, if you're trying to retire at 2005, 2006, somewhere in there, and then you see that huge market drop like we did back in 2008, that's obviously going to impact your retirement in a negative way. So that's what we talk about when we're saying, hey, we're not just here to we're not just here to eke out every single % of gain in the market that we can. We're trying to basically smooth out the ride. So we don't want to be on, Mark always says, Jack, you might have even heard this. Mark always says, you don't want to be on the, the giant roller coaster at Cedar Point. You want to be on the baby one. So that's really what we're doing here, to try and smooth out the ride based on people's risk tolerance.
So essentially, preserving capital becomes more and more important as retirees get closer to retiring.
Yep, absolutely.
Gotcha.
Yep.
And as far as that 2010 lost decade, I don't really remember that. I was playing Wii in the basement with my siblings.
Heck
but
yeah. We bowling, we golf. I was.
It was all Wii Sports, some Super Mario, Madden 11 was out, so all those good games. But so using these examples, if your portfolio drops 25%, what return would you need to get back to even?
Yeah, so that's an awesome point. So, basically it's like a 33 and a third percent return you need at that point if your portfolio is down 25. Obviously if it's bigger, like in 2008, 50% correction, you're going to need 100% return to recover from that. So that's when we talk about, asset mix. We talk about income strategy. We talk about financial plan. That all has to do with your risk tolerance. Because I think, I've mentioned this many times on this podcast. When people talk to me, like for the first time, and find out what I do, they're always asking me, like, what's the hot, stock tip? Mm-hmm. What do we want to invest in? Should we be buying Bitcoin? All that stuff. And all that is fun to talk about, especially when you're younger. But preserving that capital and having an income strategy becomes way more important than eking out all those return percentages in retirement.
Absolutely. So going on to our next question here, Derek, in dealing with both your clients and maybe even potential clients, would you say that families are too aggressive or too conservative?
Yeah, I think that's a great question. Really there's, I don't want to say complacency, but that's what has seemed to have set in. Obviously, we had a negative year in 2022. That was a historic bad year because stocks and bonds dropped that year. But it's recovered so quickly. People tend to not have felt that pain for very long. There was it was about a 20% drop, I want to say, leading up to Christmas Eve and New Year's in 2021, I want to say. And that happened so quickly, it was back and forth. So yeah, when we haven't had that pain in a long time, it's easy to forget about, and I kind of feel like that's what's happening now. A lot of these portfolios I'm seeing, bringing up that equity position, the stock position in their portfolios, and I should take a step back. There's no magic number, depending on what your age is. If you're, 61, your stock allocation isn't automatically 65% or something like that. That's where the financial plan comes in. So, and risk tolerance a little bit too, So there's what we want to really avoid is trying to chase down returns in asset classes that may be overvalued. I think that's really one of the fun things that's kind of gone on the last 5 years is chasing down volatile asset classes. So we've talked NFTs on this show before, obviously crypto, all of the Dogecoins and things like that. We need a strategy, we need a plan, especially if you're approaching retirement. So chasing down some of these fun asset classes is fun, but make sure you're doing that with a portion of your portfolio that's responsible, because we don't want to be taking that risk up too high based on returns that we've seen and be stuck left holding the bag. We need to make sure we have that allocation set properly, and we're also we'll talk a little bit more about what we should do in the next section here, but we want to make sure that things are not getting too far out of whack.
Gotcha. I mean, you think about it, from 2010 to pretty much now, besides the few dips like the 2022 and like the COVID crash in 2020, the stock market's only really gone up. And I think that some people think, and I think it's a lot of people in my generation, but maybe some people watching this think that stocks only go up. How do you how do you guard clients like saying like, well, hold on, like there are periods where like dips? How do you go about those conversations?
Yeah, no, that's a fantastic question, because you do get that feeling that everyone just thinks that all asset classes just go up no matter what. And as time has gone on in this business, that seems to be more apparent. And the swings, the 3-4% days, either up or down, doesn't really matter. Those are new things. Obviously, it's happened before, but post-COVID, I feel like people are much more trigger happy. That's why you get those big swings. When especially like gold and silver, we've even kind of seen that in the last year or so. The momentum trades are huge. So once trades start getting momentum, people want in on that. Yep. They see that, see those prices going up, and that's what sets you up for those giant crashes coming down. So I know that happened with silver. There's nothing that says it can't go back up though. So like I've said a couple of times, certainly not taking any victory laps on that, but we just want to make sure we're cognizant of our overall position, and that we're not trying to get too greedy by chasing down some of those riskier asset class, and have a little discipline as well. When you get into an investment, you're supposed to have a sell discipline. You want to know when you're going to get out. So if you buy it for 100, if it gets down to 80, you're going to cut your losses. And then the same thing on the upside too. So understanding, having that good sell discipline will definitely put you ahead, compared to everyone else out there. Makes
sense. So what would you say is one of the easiest things that you can do to reduce risk in retirement?
So that's what I was touched on a little bit earlier. Just rebalancing your portfolio quarterly. If you're not working with anyone, or you're just saving into your 401k, things like that. Just a simple rebalance once a quarter, twice a year, something like that. Is a proven way to reduce your risk and increase your returns over time. So, in case you don't know what that is, let's say you've gone through all this stuff, and let's say you're in a 65-35 portfolio. So 65% stocks, 35% bonds and fixed income. Let's say throughout the year the stock market had a great year. The price of the stock goes up, and now you're 70% weighted into stocks. Well, rebalancing, we just take that 70, put it back down to 65, probably buying some bonds in that scenario, just to rebalance the overall portfolio. That is something that I feel not a lot of people do regularly because of what we just talked about. We're looking at buying Bitcoin or some JPEGs out there. We're not really thinking about rebalancing our 401k. So yeah, just doing that rebalancing, and that also helps you out with knowing what your allocation is. So as you rebalance, maybe you want to get a little bit more conservative as you're getting older. As you're rebalancing, those are the times where you can start to make decisions like that. What we want to avoid is making huge bets in or out of the market.
Makes sense. And throughout this video, you've laid out a lot of good facts and pointers. So how do you put this all together, like practically, for your clients?
Yeah, absolutely. I think it's about balance, right? So understanding what your risk tolerance actually is really the first key. So if the stock market goes down, for 2 weeks straight and your portfolio is down 10%, like if you just can't handle that, then you need to adjust your balance. If you're maybe a little bit younger and you're okay with the ups and the downs, maybe that's okay. So you just have to understand what your portfolio mix is like, what it should be, and then as you're approaching retirement, that's when the financial plan comes into play, and that's when the income strategy comes into play, because not all of your assets need to be working the same way, right? You can, when I'm working with my clients, I'm always trying to make sure they have a steady stream of income so they can actually take a little bit more risk on their investment side. So, just balancing your risk tolerance with safety and income is going to be, super important for you. When we talk about the plans, inflation, interest rate risks, we always want to make sure we're cognizant of that. We're inflating the expenses in our financial plans at 3% per year. So we don't want to run out of money just because we're not planning for inflation. It's the longer I do this, you may be in a similar strategy to someone in a similar point in life as you, but this is basically custom stuff. So you really need a custom look at your overall allocation, your overall strategies. People come in here asking all kinds of questions about Roth conversions, about all kinds of investments, about tax strategies. All of that stuff is impacted when you make other moves. So, having a high level plan and then being able to execute it, is something not a lot of people can do on their own. That's kind of what we're doing here on the planning side, is really kind of guiding our clients into, through that pre-retirement stage and into retirement.
Makes sense.
So, all right. Well, any final words here, Jack?
No, this was a fun time. Learned a lot more from Derek here today, and hope I'll be on here again. But yeah, great
Awesome.
Time.
Well, good stuff. Well, thanks for listening out there. If you guys have any questions, comments, show ideas, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.